So I know we're the last session standing between you and the end of the conference. But still, co-investment is a very interesting topic, so I'm going to try to keep you with us for the rest of, I think we have 40 minutes. And in essence, you know, co-investment, initially, I think, the history of it, it came from governments and supranational institutions who acted as anchor investors in emerging markets. And the history of it, it was, you know, if you look at the World Bank, the IMF, the European Commission, when they came to Africa first, you know, giving loans to governments and then giving money to projects and then companies, etc. So moving along, you know, the chain of assets, they realized that some kind of discipline, investment discipline, was only found in the private sector. And when I say private sector, it's not only pension funds, but it's also fund management companies and private equity companies. And so it made sense to bring them to these anchor deals in these frontier and emerging markets, if only to give it more legitimacy and more investment discipline, because the underlying idea would be, you know, if you're the World Bank or the IMF or the EU Commission, is that when you're co-investing with these sophisticated private sector companies, it forces you to be disciplined. If you are a private sector company based in New York or Montreal or Ottawa, the interest of co-investing with a government or IFA or supranational is that these emerging market, these African jurisdictions, maybe the rule of law, maybe the fiscal transparency, maybe the legal and regulatory efficiency is not as good, as safe as in London or Montreal. So country risk is a big issue. And of course, being a co-investor with a blue chip supranational kind of shields you and protects you from the local risk and volatility. So I think this is how initially the thinking behind that notion of co-investment started. And I will turn to my fellow panelists and let them, you know, give us more flair and flavor as to how they came to the notion and how they approach co-investment in emerging market and Africa.
You want to start with me?
Yeah, start with you.
Okay. So my name is Mindy Silverstein. I'm the managing director of the Milken Institute, and it's great to see many friends around this room. I will say that I am probably the newest newcomer to working and focusing on Africa of probably anyone in the room, and I would say that's a really great thing for everyone who is in this room and has been focusing on Africa probably a lot longer than me. For you, if you don't know the Milken Institute, we're an economic think tank. We're based in California and have an office in DC and are increasingly doing work globally, and really that's following the interests of our community. We work with global institutional investors and leaders in the financial community, and then going back to what our founder said when he started his first speech on Wall Street in 1969 was called "The Best Investor is a Social Scientist." And so all of these investors globally are really thinking about what is happening in different markets, and many, I don't need to tell anyone in this room about, you know, the demographics and things like that that make Africa and other frontier and developing regions appealing. What I would say in terms of co-investment, which I didn't know that was what my question was about, but I'm happy to talk about it. You know, you mentioned, you know, we talk a lot about, you know, now these investors understand why they need to invest, but now they're trying to figure out how to invest and with who. And so I think that is what we sort of see all the investors, the very many different types of investors trying to demystify and figure out right now. And so what are the right vehicles for their investment? Some of them, and I will say, just to diverge for 1 second, there are so many different types of investment. Kim just said this on the last panel about the shoe fitting. I mean, people talk about there are 54 countries in Africa. I promise you there are more than 54 types of investors who have different risk-return profiles and interests. So that is a very difficult thing, coming up with that match. And so for, you know, if you're a US pension fund, you probably aren't allowed to, you don't have the resources to really kick the tires on deals. You're probably going into private equity maybe. So you're looking at the expertise of those type of, you know, partners where you're going to co-invest. And I think obviously there's discussion about the DFIs. Many people in this room could talk with much more expertise about DFIs and the roles that they play. The other partner that I would mention that I don't know if has come up is multinationals. And we work with many multinationals, and I think that for global investors, they're very assured if they're going into a deal and a multinational is involved in some way. So I would use GE or Cisco, any of the companies that we're working with now, and they're not in these countries for, they haven't been there for just a few years. They've sometimes been there for 100 years or 50 years, have been there for a long time. They have expertise. They're spending time with ministers and heads of state and things like that on the ground. And frankly, they're coming, if it's Western capital or Western companies, they're coming under the Foreign Corrupt Practices Act and things like that. So that's also an assurance for a lot of institutional investors.
Thank you. And I want to say that Milken has been at the forefront of research in many sectors. Two of them are financial services and healthcare. And of course, in Africa, for demographic reasons and also for benchmark reasons, these sectors, financial services and healthcare, play a big part and represent a big chunk of value all across Africa. Now let's turn to Susan Bishoprick, who's a Canadian citizen, so she comes from a country which is famous for its large and sophisticated public pension funds. But she also was, before co-founding Global Sovereign Advisors, she also was for many years the chief investment officer of the UN Joint Staff Pension Fund. So she has I would say, global supranational pension fund perspective and experience. And of course, many members of the UN are these 54 African states. So you could say that she was on both sides of the fence, and I think it's going to be fascinating to hear what she has to say about the issue of co-investment.
Yes, and thank you. That was a kind introduction, but just to complicate the DNA picture, my Montreal family arrived via my ancestors who were from Tripoli, now in Libya. So I have my African side too. But I really was fascinated by the discussion about co-investment, because I actually looked at a study over a year ago about co-investing by Canadian and US pension funds. And not just in Africa, but global co-investments really have a wide distribution of results. And unfortunately, a lot of the infrastructure and co-investment deals that were taken outside of large funds didn't work out very well. So my advice is, if you're going into Africa or other international investments and looking at co-investment, you're better off with a diversified portfolio. Go with the fund manager who has lots of different projects, but don't buy into the supersized one. If a deal is too big to fit with the regular partnership arrangement, there's a reason for it, and exercise caution. Infrastructure, for those of us who live in New York now, it has some warning signals. It's a low return government rate of return, but high risk. I'm living very near the 2nd Avenue subway, which has been under construction for nearly 100 years. So there is political risk, and it's not always because the local atmosphere isn't pleasant. I think New York is a wonderful place to live. I've enjoyed it, almost as nice as Montreal. But this subway still is not built. So be very careful. But Africa really is a unique growth story now, with 50% of the African population under 25 years of age. Economic growth is imperative, and so far so good. For the past decade, sub-Saharan economies have been growing above 5% per year, and investors have been rewarded. When I was at the UN Pension Fund, we were lucky to be able to invest in some private equity deals, even though many of our pensioners, who tend to be very vocal about where the chief investment officer invests their money, they were a bit concerned about our investments in some of the banks that were on the panel a few minutes ago. They said, "You're investing in Nigerian banks? That sounds really scary." Now, suddenly, it's a motherhood statement. And I thank you for generating the wonderful returns, because now as a retired UN pensioner, I'm living off of them. But we must keep the risks in mind. Commodity prices have been weakening, and with 87% of government expenditures derived from commodity exports, and not just petroleum, this has already put some pressure on certain budgets. This week's news about Volkswagen's pollution controls, or lack thereof, has put sharp downward pressure on platinum, a key element in catalytic converters. So there are recent budget and reserve management challenges that we all have to be very painfully aware of, and they're being handled differently. Kenya has raised interest rates to support the shilling, and Egypt has taken steps to reduce the ability of foreign investors to repatriate earnings. So these are things we have to be mindful of, and unfortunately, I think the rating agencies are always slow, both to pick up the good news as well as to warn us of things that might be developing. So where do you invest in Africa today if you have a really long-term perspective? I would look very closely at the spirit of cooperation that's going on with the June 15th announcement of the tripartite free trade area. The TFTA will bring together 26 member states, more than half of Africa, creating many sound investment opportunities. Facilitating cross-border trade within Africa will enhance growth prospects, not just for traditional commodities and manufactured goods, but for some cutting-edge financial innovations. Infrastructure needs are significant, but as in other entrepreneurial ventures, necessity is the mother of invention. Speaking of successful African inventions, focus on different solutions, such as M-Pesa, software which allows payments on phones in Kenya. And this is expanding into other countries and other types of technologies. The USA's Apple Pay is a Johnny-come-lately. Now, I expect to see many further surprises for software developers in this world, with rapid innovation occurring to ensure payments and data security on telephone systems in Africa. And I'm looking closely at some security products coming out of South Africa today. My start with African investment was backwards. I heard people in the last panel talking about the dominance of South Africa. My first boss at the United Nations was Kofi Annan, and he warned me about the very important boycott of any South African financial institutions. So we were everywhere else in Africa until more recently. And a historical perspective is appropriate to see how far we have all come. This is just a wonderful tribute, not just to Africa, but what the investment creativity has done. Now, on this day in 1962, Algeria declared its independence from France, and the CFA franc, which was Colonie Française d'Afrique, that was launched in 1945 to protect African colonies from the devaluation of the French franc. Now, the French franc is no more, but all CFA zone members, and there are two different groups, still have to pool together about 65% of their reserves into an operations account at the French Treasury. Now, that's a lot of assets to outsource to a single fund manager, whether it's to another central bank or to Wall Street. Now, I hope the performance has been good, but even so, after this many years, it might be a good time to revisit the terms and conditions. Moreover, since France joined the euro, the CFA linkage to the euro now binds exchange rates and monetary policy in 14 African countries to Europe's internal politics, including Greek debt negotiation and Great Britain's vote on the EU. Now, ties between Europe and Africa remain robust, but more investment now is coming from China and the USA. and the diversification of reserves should give due emphasis to these investment implications. So a reform of the currency arrangements, such as was advocated recently by the African Development Bank, might be a further catalyst for growth. And we're going to be monitoring these developments because I think the French-speaking side has some catching up to do. And I think that's you know, it's going to happen at some point, and we're ready for it. Thank you.
Thank you. I mean, I'm personally part of the French-speaking side, but I'm agnostic. I'm agnostic on the issue. I think there are pros and cons.
Well, from Montreal, we have to look at the French-speaking side.
Let's move to Melissa Cook, who's of African Sunrise Partners, but she's also part of President Obama's business advisory group, and so she has two hats, and she will tell us how she views co-investment and investment in Africa.
Okay, well, I first have to say my Milken connection is that I started my research career at Drexel Burnham, which was where the home of Mike Milken, and I still have a T-shirt that says "Junk Bonds Keep America Fit." So I think fondly of those days, just a few blocks from here. I'm going to give a little bit of background and some perspective. I've worked in Wall Street banks for 25 years as an equity research analyst covering all types of global sectors. Started traveling to Africa as a tourist in 2007 and very quickly realized in Kenya there was really something very different going on. It wasn't just when our travel guide pulled out his phone and made a payment using M-Pesa when they were in the absolute middle of nowhere. It was the shopping centers, the billboards, the GT Bank advertisements in Heathrow, and I just said this is really something different. Started my own business 5 years ago basically to try to bring more institutional investors and more US companies to the continent. I always joke that my clients are Americans who think Africa is one country. And so for the people who think that, who are in this room, thank you for coming because it's a really good opportunity just to get from the horse's mouth some of the great information that you will need. So what I do is travel to the continent 5 or 6 times a year, more than 35 trips, almost 40 trips overall. And I go and talk to almost anyone who will talk to me. That's everyone from my driver and the people in the informal markets, all the way up to the biggest listed companies, the dealers and distributors for Caterpillar and Coca-Cola and the other multinationals. And I think it's so important to have, as we heard from some of the previous speakers, boots on the ground. There's just nothing, there's nothing to substitute for actually going and seeing what's really happening and going back on a regular basis and then going to new countries and seeing where maybe that country is headed that's slightly different from the ones that you know something about. So in my regular work, I don't focus so much on co-investing, so sorry, I'm not going to emphasize that, but I'm really very interested in bridging the gap. So I spend a lot of my time speaking with institutional investors here in the US, and also speaking with African governments, with regulators, with business, to try to help each side understand or translate into a language that everybody can understand. So for example, we've heard from some of the pension funds that are thinking about increasing their Africa allocation. Where I see most of my business is really with the global fund managers who are running a business where they have a fairly liberal allocation in terms of being able to go global, to go frontier, to go emerging, and they're interested in where the next driver of growth is going to come from. But too many people look at Africa and they say, oh my God, 54 countries, it's a lot of work, it's pretty far away, I'm just going to go do something else. And so I think my message to the African companies and regulators and governments is anything that adds complexity makes it more difficult for an investor to justify spending the time going to that country. I do it, I'm happy to do it. I've logged almost 5 million miles with American Airlines and its affiliates, but you know, not everybody's willing to do that, and it's a lot of work and a lot of expense. The other thing that I hear a lot about is let's get people to come into projects. Well, as we heard on one of the panels before, big institutions don't buy projects, they buy financial instruments. And this is something that I've been working very closely with my colleagues and partners on the President's Advisory Council, of which Wale is one, to try to help people understand the need for development of African capital markets, as well as additional securities and vehicles that maybe are listed in New York or London or Mauritius that are more investable and more liquid for these really big institutions. It's very simple math. If you're running a $100 billion portfolio and you have 100 positions, you have the math that shows you how long you have in your bylaws to how many days trading volume, you know, how many days it's going to take you to build a position and sell a position down. So I'm actually quite encouraged by what I see in terms of the securities exchanges. I thought we had some very good commentary today. I always visit stock exchanges when I travel, and I think there's a lot of innovation. There's a lot of consistency coming through in terms of the technology and the regulatory environment, and that's very helpful. I was able to attend a Milken Institute event in Kenya, at which I spoke up and said to some of the private company CEOs that were in the room, you guys should be listed. If you were to list, you would add another $1 billion of market cap to your local stock exchange, and let's just get that to happen. I think there's an opportunity for dual listings. I understand why companies want to be listed locally to develop their local stock exchanges, but I think it makes it much easier for big institutions if companies can be listed also maybe in Johannesburg, maybe in London, maybe in Mauritius. It just makes it much easier. And then again, in my function as a bridge, I'm really trying to get people to think about creative new vehicles that will open up what I view as a wall of money in the US that's looking for an opportunity to invest in growth but can't make the math work. And I think we've got lots of opportunity. And then finally, in my business, I go out and I kick the tires and do all the groundwork, and I try to educate the very most senior people who are on the boards or the chief investment officers. And one of the speakers earlier said, going into, say, Africa Rising is not going to pass the board. That's totally true. And you have to have somebody inside the team or an advisor to them who's able to come in and say, I've seen all these companies, I've seen these countries, and here's what's really happening and going on. And I just would encourage the big investors to find the budget and find the staff, go to the Harvard Africa Conference and pick somebody out of the graduating class or one of the business school conferences to find people who are willing to get on a plane and go and do that type of research. So that doesn't answer the co-investing question, but hopefully it gives you something else to chew on.
No, that was extremely interesting, and I'll come back to some of the points you made later on, but first let's hear Wale Adeosun of Kuramo Capital, both on what he does on a daily basis as an institutional investor in African jurisdiction, but also what he would expect from fellow co-investors, be they public or private, from the Northern Hemisphere.
Sure. Thank you for inviting me. Wale Adeosun, founder of Kuramo Capital. We founded Kuramo Capital in 2011. We have offices in New York City. All investment professionals are on the ground in Lagos and Nairobi. When we started this, it was based on a value proposition that evolved from my prior life at RPI, Rensselaer Polytechnic Institute. When I joined RPI in 2004 from Chicago, the MacArthur Foundation, the goal then was to help diversify the portfolio for RPI across the world. So obviously then moved into investing in China, India, Latin America. But when we moved out to China and India, there were two things we always looked for. One, could we find groups that looked like the best in class that we'd found here in the US? And then the second question was, did we have a local network that could help us navigate the local landscape? So the answer to the first one was yes. We could find groups we find people that were generally educated here in the US, maybe grew up in China, came into the US, and then went back home, and then used their local networks to give them an edge on the ground. We found those groups in China, we found them in India, we found them in Latin America. And the other thing too was, in terms of the local network, we had a trustee of the school who at the time was running the largest bank in Singapore with DBS Bank. And so pretty much every year I would make at least one trip to Singapore so he could give us his sense of what the lay on the ground was. And so it was eyes and ears. And then we said, after doing China, India, Latin America, we said, well, what was the next region that was attractive? We came to the conclusion that it was Africa at the time. And in 2006, we started investing in Africa on behalf of RPI. And by the time I left RPI in 2010, we'd committed close to 5% of the endowment and pension assets to investments in sub-Saharan Africa. And so the value proposition for today, Kuramo, is really let's go help a select group of institutional investors capture what we believe is this tremendous sub-Saharan Africa growth opportunity. We started that in 2011, like I said earlier. We put to work over $100 million. Our model is a very flexible one. We can invest in funds, we can invest in directly, we can make co-investments, we can invest across all asset classes. The goal is really to generate really very attractive risk-adjusted returns. Now, when it comes to co-investments, I mean, I think if you look at co-investments from the perspective of the GP, obviously, it generally works like he's found a great investment, probably does not have enough capital or cannot dedicate enough capital because of some of the restrictions on the fund to a particular investment, so he's looking to share that with some select LPs. The way that works is he can decide which LPs he wants to select and give that opportunity to. Some of them may be more democratic and share with everybody, but it varies. Now, if you're an LP and you're looking at co-investment opportunities, obviously, I mean, I think what typically happens to LPs, if you've already invested in the fund, one of the things that says about you, obviously, is you do not have the capacity or the wherewithal in-house to evaluate investments on your own. So, obviously, you can make direct investments. But what happens is when they show you a co-investment, which is a very attractive one, you're getting to ride on the coattails of the GP as well. And in the good old days, I think when it first started, co-investments first started, there were no additional fees on the co-investment, so you could reduce your fee load overall as an investor there. I think that's changed, particularly in developed markets. It's not the case in Africa yet, but I'm sure we'll probably get there as well. So you have a chance, obviously, as an LP, to participate in a co-investment that will help you improve your returns overall. Now, and I think more investors now are looking into that as a way of boosting the returns and lowering fees. What we've done actually at Karamo is actually done something interesting, which is actually created a co-investment vehicle that's a committed co-investment vehicle for you. So if you're looking to invest on the ground and you want to get exposure to some of the best ideas of some of the managers, we have a vehicle for you that you can actually use to make that investment. Now, why will managers want to share their best ideas with us? A couple of reasons. One, what we do at Karamo is we're early investors in a number of managers, right? So we will go in early and be an anchor to a manager. And as some of you know, if you've tried to raise a fund, it is really a tough thing trying to raise a fund. So if somebody's going to raise their hand to be an anchor, that means they should get some preferred terms. And so we generally will get those preferred terms being an anchor investor. We can also totally seed a manager, which is even take a % of the GP as well. And so we'll do things like that and then introduce you to our local network that can also help you in terms of funds. We've done that for a few managers on the ground now. And so that generally gives us access to some of the best ideas when it comes to co-investments. I think the overall theme around co-investment is probably coming from what people are finding out is the case in Africa today. And I think it's all about deal flow. We're finding that more funds are being raised to invest in Africa. And that's fine. It's still early days, but more funds are coming. And so what happens is, as more funds come, obviously the key to success is being able to find deals that are not being auctioned off. I think if you think in terms of the plethora of deals out there now, if you're looking towards the larger cap deals, they're generally going to be auction deals that everybody knows. So how do you get this edge in terms of deal flow? To get that edge in terms of deal flow, we strongly believe that the teams that are local will win the day, right? So this is going to be the guys that grew up on the ground, went to high school on the ground. They go to church on Sunday with some of the local players and some of the local companies. Those guys will have the edge when it comes to deal flow. And then their ability to co-invest or share some of those deals with you will really make the difference in terms of your returns going forward. So I think some of the savvy investors have figured out that, look, to really juice up my returns in this part of the world, I have to get exposure to co-investments. But to get that exposure to co-investments, you're going to have to find really local groups that have strong local networks with a lot of local companies. Because let's face it, private equity is a new asset class to Africa. It's a new investment type of structure to most companies on the ground. Most companies on the ground in Africa are used to debt. You give me some money, I'll pay you an interest, and you don't tell me how to run my company. This is a different structure. What we're proposing here is we're going to be your partners. We'll provide capital to you, and we'll provide some advice in terms of let's see, help you generate more revenues. I think about really consolidation will help you in terms of improving your productivity, will help you in terms of thinking about exits. These are all new issues to most companies on the ground. But they'll find comfort with groups that have helped them in the past, guys that have worked with them in banking on the ground in prior lives. And so that's the trend on the ground, and that's why I guess the emphasis is on co-investments.
Thank you, Wale. And now I'm going to comment on what Melissa said earlier. Now, in full disclosure, I had never met Melissa or Mindy before, but we agree on something.
You didn't notice.
I didn't notice, but we are all in different ways Kenya files, and the way that I had the same kind of reaction, sort of eureka moment, when I first met Kenyan pension regulators 12, 13 years ago at the OECD in Paris. I was really impressed by the quality, the intellectual quality of these bureaucrats from a lower middle income sub-Saharan country who knew about pension economics and regulation better than many of the French or British civil servants in the room, and that's where I was really impressed. And Kenya has certainly risen a lot in the past decade, and all the more because they have very little commodities, oil, diamond, gas, and this is the mixed curse of the curse of commodities. Many of these cash-rich, commodity-rich Middle Eastern or African nations, and then the same applies, of course, to Russia, Australia, and Canada. When you have a cycle of rising oil and gas, things are easy, and anyone can make a lot of money in all sectors, not only in oil and gas, but also real estate, etc. And all of a sudden, in just 2, 3, 4 months, everything crumbles, and because everything is correlated, once again, you start seeing people rioting in the streets in Rio. And Kenya, from that perspective, is a very good counterexample. It's a country which relied heavily on gray matter and on a human skills, education, and I think they're starting to reap the fruits of the plants that they have, the seeds they have planted 15, 20 years ago. Also, I think in many ways, if you allow me to make a metaphor, and using here the Milken Institute and Mindy on my side, is that in many ways, if you study the economic development of the Middle East and North Africa, 22 years ago, Israel was somewhere between Yugoslavia and Portugal in terms of economic development, i.e. Israel was a mediocre middle-income nation. In some sectors, it was behind Yugoslavia or behind Portugal. So in just 15, 20 years, it's remarkable how it has become a very sophisticated economy in many of the most advanced high-tech sectors, and in many ways they jumped right from agriculture and socialist agricultural associations right away into high-tech, and once again the sectors for which Milken has some expertise, financial services, biotech, IT, and I think in many ways a country like Kenya, everything else remaining unchanged, has the skills to make that kind of jump, jumping from a rural sub-Saharan Africa frontier market. They have the educational, intellectual capacities, and beyond Kenya, you have all the African diasporas in London, in New York City, and they are also contributors to investment in Africa by putting some of their own money into venture capital, real estate in their home country. And I think Kenya is also a great example of these diasporas reinvesting the money they earn in North America or the UK back home. And maybe if Mindy can tell us a little bit about the kind of research they did, for example, with Israel in biotech or high tech.
Yeah, I think that, we did a project in Israel that I think you're referring to. We met with President Perez, and he was talking about human capital, which is basically what you're talking about, and how that is, we talk about obviously that human capital is the most valuable asset of any economy, and a lot of work that's been done over the years in that area. And So when we met with President Perez, he was talking about that, the people were the oil fields of Israel. And yeah, he called them perfume in a bottle. He said, our people are going out and then they're not returning. You can't get them back into a bottle. So anyway, we ended up doing a project, because basically they have like Teba, and then they have the Technion lab. And they didn't have, sort of the domestic sources of capital or the sources of capital to put into growing these SMEs, to grow and to realize the potential and create jobs and things like that. And so we ended up working with the government there to structure a public-private partnership where the government, the Israeli government, committed $100 million, and then Orbimed actually won the tender and then raised the money. But we helped to design the structure. So as obviously a nonprofit, we don't participate in that in any way. But I would tie this back to Africa in that in the session that we did in Nairobi. And this is maybe a little bit of a question for some of my colleagues. Melissa and Wale were both there. But one of the Africans, a Kenyan actually, was talking about the projected growth rates, that many of the countries want to realize. They want 10% growth. We're just projecting 10% growth for the next 30 years or something like that. And they pointed out, as we were trying to bring more global investors in, I don't know if you remember this comment of no country has ever realized that type of return if they didn't have more domestic investment versus foreign direct investment. So I guess one question I would have as you talk about co-investment is the opportunity for sort of more education and sort of the evolution of sovereign funds and domestic savings.
Well, I mean, I actually am about to publish the report from that trip, which is about a month overdue, but I've just been running some numbers. I don't tend to get very bogged down in statistics, but the shocking thing is the GDP growth numbers in Kenya are actually a lot lower than you really think. And you see that in a lot of countries. If you look at population growth, you look at real GDP growth per capita, it's not a very encouraging picture in a lot of cases. And what really frustrates me about this is when I go to these places, you see government getting in the way of so many things that look like such low-hanging fruit. And time is of the essence. There is this population boom going on, and whether it's the domestic savings, whether it's reversing the outflows of corrupt money that's been stolen from some countries, whether it's getting rid of visa requirements, whether it's just getting the civil servants on board, the energy of the young people to create new businesses is being stifled in so many cases. And there's almost, I don't think there's a single country in sub-Saharan Africa that I spend any time in where the real underlying growth rate is enough. It's taking 7 years to get a power plant online. It's all the other things that could be opened up if government would just say, all right, run with it. Let's get this to work. So again, that's.
Yeah, I think my observation over this last few years, I feel like, my prior life I invested across the world, and I was never really deep in one particular area. But now I've really been deep. I feel like I've gone to a PhD when it comes to Africa. I think the trick with Africa, frankly, is a lot of the numbers that you hear quoted around, you cannot trust them, right? And they generally don't make sense, right? April last year, we were in Nigeria. We had an investor conference. I think the following month or the same month, the government woke up and said the GDP was double. And nobody blinked. I mean, can you imagine if that happened in the US? Right? Just like that, the GDP just doubled. Right? So what that tells you is, and then if you've done some work in terms of the profitability of companies in Africa, which we have done and which is what we look at, the likes of the telecom companies is generating incredible profitability, 50% EBITDA margins, 120 million subscribers. And it's not going to be like that Africa or Nigeria in this case has 120 wealthy people. So for some reason, it must be a case where people we think are not wealthy or don't have disposable income do and are spending it. And that's why these companies can be so profitable. The informal economy in these countries are just so huge that you can't. Have you ever run into a Nigerian that gave you one business card? They'll give you 3 business cards in like 2 minutes for 3 different things they're doing. And if you give them a business card, they'll look at you like, what's wrong with you? Right? I mean, so how do you capture that? You just can't. And so you have to really take these numbers with some measure. Well, you have to go back and say, why are companies doing what they're doing, right? Because to me, that's what's more rational, right? Wall Street Journal did a survey earlier this year. They asked about 200 companies of all the frontier markets, which are the countries you would like to go to? Nigeria was number one, right? And then Vietnam, and then Kenya. There's a reason for that madness, right? I mean, this is because these companies are all about making money. You know, when Jim O'Neill coined the term BRICS, I mean, I think people missed part of what he was focusing on was the demographics and the numbers. You know, in as much as Kenya can be very attractive to you guys, you know, my partners are from Kenya, so they know we go through this back and forth every day. The fact of the matter is Kenya has a population of what, 40 million people max? Nairobi is like one little suburb in Lagos, right? So when it comes to markets, I mean, I think that's what you have to think about as investors, right? You have to think about how big is this market so that if you're going to sell something that's $1 to 200 million people, that goes a long way right away. The way you think of Kenya is more as part of being a member of the East African community, where now you can get about 200 million people. Right. That's what you have to think about.
Thank you, Wale. And I think on that contrast between Lagos and Nairobi, we'll have to wrap up this roundtable. I think we have just time enough for one question from the audience, if anyone wants to interject or ask us a question. If not, I will give the floor to my colleague Barbara, who will wrap up. Barbara?
Okay, well, we have to celebrate again the foundational basis that you guys have given us. And so please join me in thanking everyone.
Doing business in Africa. You can't afford to be without Africa Investor.